Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just doing another velocity banking review with the emphasis on paying off three car loans. And I don't know if you ever heard this saying before, but they say that in the car business, a car is an excuse to sell a car loan. And I asked ChatGPT this, is it true? Is it true? So let's go ahead and listen to ChatGPT's answer.
Yes, you could look at it that way. In the context of sales and financing, a car often serves as the hook to sell the associated financing, such as a car loan. Many car dealerships make significant profits not just from the sale of the vehicle itself, but also from the financing options they offer. Here's how this works. 1. Focus on monthly payments. Salespeople often emphasize the affordability of monthly payments rather than the overall cost of the car, making it easier to upsell both the car and the loan. Number 2, add-ons rolled into financing. Dealerships may encourage buyers to include extended warranties, service packages, or other add-ons in the loan, further increasing the loan amount. 3, interest rates and fees. Dealerships might offer financing with higher interest rates or fees than other lenders, and the profit from these financing arrangements can be significant. 4. Longer loan terms. Extending the loan term lowers monthly payments but increases the total interest paid over the life of the loan, making the financing more profitable for the lender. So, while the car is the product, the financing is often the profit driver for many dealerships. It's a smart business strategy for them, but a good reminder for buyers to carefully evaluate financing terms and consider alternative lenders before committing to a car loan.
All right, you heard it from ChatGPT, folks. So this is what we're gonna do, just like we do almost every single day. And remember that cartoon from a long time ago, Pinky and the Brain? And I think it was Pinky who'd always ask, like, "What are we gonna do tonight?" And then Brain would always say, "It's time to take over the world," and then he'd always fail at it. Well, we're kinda gonna be like that, except we're gonna pay off debt, and instead of failing at it, we're gonna be successful, and we're gonna do it with 3 cars, okay? So, what's velocity banking? All it is a debt payoff strategy where you throw all your money into debt with the help of line of credit, right? And we call the line of credit our main operating account. So there's really 2 things that we need to do for velocity banking. Number 1's a budget, which is our debt attack plan, right? This is where we're paying off debt. And as you can see here, we've pretty much done this with this person right here, we call the average American. Income 6,500, expenses 5,900, two major credit cards, two big credit cards, three auto loans. I'll say that two of them are new, or maybe yeah, one used, right? Three auto loans, and then a $200,000 mortgage, along with food, gas, insurance, and all that other good stuff. Okay, so this is what we're gonna do: same income, same expenses in this velocity banking side, and then we're gonna copy and paste, but we're not going to do the thing that Americans are told to do, which is have savings, right? I don't need savings, right? Why? Because I got something called a line of credit, which acts as my savings account, line of credit. Okay. So if you take a look here, I don't have any savings here because when money comes into the checking account, it just immediately goes out to the line of credit, right? And if you have never seen a personal home equity line of credit, this is what I see when I log in through my cell phone. In fact, I don't even log in. I just do the quick balance feature, meaning you swipe and it tells you what your available balance is. Isn't that cool? So that's what I do, right? That's what I do with my when I have access to my line of credit. I could literally just log in and tap a button and get up to $280,000. Not interest free. They charge me actually 7% interest now. They used to charge me 8 on the contract. It used to say 8%, and now it's 7%. They lowered it to 7.75, and then I logged in today, and they're really generous and gave me 7%. It's crazy, right? So all line of credit is a financial tool where you could borrow money, pay it back, and use it over and over again. And we're gonna assume we have access to a line of credit. Okay, we'll say we have an access to a $65,000 line of credit at an 8% interest rate. Now, here's the thing. I know what some of you are thinking. You're all gonna say, like, "This is unrealistic," right? Who's gonna lend me, that much money? Well, again, unrealistic for you because you don't know what the banks are looking for. And banks don't lend money to people who need it. Okay. I can't emphasize this enough. And so the biggest problem that you have when it comes to debt is that you're always trying to get money when you need it, and you can't do that. Okay. All right. So let's go ahead and get started. And so we see that we don't have any savings, but once we move some debt into the line of credit, we're going to do this cool thing called the final step, right? Which is we put our entire paycheck into the line of credit and then take our expenses out. And then after every single month, the cash flow will be used to kind of deplete the debt that we have in the line of credit. Okay. So, how do we know which debts to move to the line of credit first? Well, the easiest way is the cash flow index, right? And if you don't know what the cash flow index is, all it is a formula of the statement balance divided by the um, the payment amount, right? And the lower the number, that's the one you want to use. So if you want to see me do this, I just type in CFI cash flow index. Kind of boring that I got to do this manually, but 27,000 divided by 855. This one is 35,000 divided by 1137.5. And then this one is 20,000 divided by 386.66. And then this one is 25,000 divided by 460.3. And then this one is 12,000 divided by 237.61. And then this one is 200,000 divided by 843.21. And then as you can see right here, let me actually make this a little bit easier to read. Format cells, 2 decimal places. Okay. Think of this as a ranking system, and the lower the number, that's the one you want to pay off because you get more bang for your buck for paying it off, right? So, would I pay off this $200,000 mortgage just to get $843 back in my cash flow, or just 27 grand to get 855? I'm definitely going to pay this to get the 855, and that's what we're going to do. All right. So first things first, let's start off with these credit cards, which we'll do. And I think the credit cards are $62,000 of debt. 62,000. So let's go ahead and do this. 62. Start off with the credit cards, right? And here's what we're going to do. 00. And now we literally went from $579 to $2,572.22. And again, last step, paycheck into line of credit, expenses out, and then rinse and repeat over and over again. Okay. So we're going to do this, and then we're going to just do this minus 2572.22, and then take the average daily balance, right? Multiply it by the interest rate, and that's 0.08, and then you divide by 12. So you want to deep dive on the formulas. Well, if you want to get the next month's balance, it's the previous month's balance, previous month's interest minus the cash flow number. And then the interest is the average daily balance of these two divide times the interest rate divided by 12. And if you don't understand it, just do it over and over again, and you'll eventually get it. Okay. All right. So now let's go ahead and copy and paste all of this. And we see that in 27 months, okay, we paid off the credit cards. And so I'm going to do this right here. So we'll just say 27 months, and that's 63 or 62K of credit card debt. Okay. $62,000 of credit card debt. And so let me go in here. And so now we have to reference our loan calculator. And then in our loan calculator, we just put what the balance or the current month is. And then as you can see right here, all of these cash flow indexes are a low number. So we can take the sum of these and then get the cash flow back from the 3 loans. So let's go ahead and do this. And not G6, it's G4. Okay. So 33 grand, we're going to move 33 grand into the line of credit. Let's go ahead and do that. And this will be plus 33213.17. And then now this is what we're going to do. All these auto loans are paid off, right? And so now we're going to pay off the debt from the auto loan within our line of credit and then use our cash flow to pay it off. So let's go ahead, and what's our new cash flow right here, which is 3,600. So now this is going to be 3656.79. And then now I'm going to update these numbers and see how fast we pay it off. Ta-da! It took us 1, 2, 3, 4, 5, 6, 7, 8, 9. Just 9 months to pay off these car loans. Well, the rest of the car loans. Technically, it took us 36 months, which is 3 years, but that's the 2 credit cards and the 3 car loans. But you see how easy that was? You see how easy that was? Oh my goodness, 36 months. Okay. So now 36 months, and then now it's 62 plus 20 plus 25 plus 12. 119K. Okay. So now, after 36 months, what's the balance on the mortgage? All right, let's take a look. 36. And so now this is 000, right? So it's 187,000. Now, after 3 years, how much of the mortgage principal do we actually pay off? Well, let's just kind of do this. 36 months, we paid off 200 minus 187, about 13K of the principal. Now let's just do this, okay? Let's move 13K of the principal into the line of credit. 13K, okay? Let's do this, plus 13000. How long does it take to pay off that 13K? 1, 2, 3, about 4 months. Oh my goodness. So when we did it, it literally just took us 4 months. So let me make that a little bit bigger. 4 months to pay off the 13K. 4 months, right? So we've accelerated paying off the principal easily by not segregating our income and just dumping all of it in and paying it off with our cash flow. See how easy that was? That wasn't so hard, was it? And we're just going to do the same thing over and over again. Now, we can't really accurately determine what the payoff is by doing this way because you're actually making the monthly payment when you're doing it this way. So it's a little bit hard, but we have a calculator that's a little bit advanced to kind of show us how to do this. So give me one moment. So this is the Renatus Velocity Banking Calculator, and again, quick plug, shameless plug. I- if you're interested in learning not only about velocity banking but real estate investing and financial literacy, click the Google form link below. I get paid when you buy products from me. Full disclosure. There you go. All right. So all I got to do at this velocity banking calculator, and again, I didn't create it, Renatus did, is I just plug in the numbers and it'll tell me the debt payoff. In fact, let me actually put in some numbers here. That's correct. So what's the mortgage? The mortgage is 200,000 at 3%. So this is 3%, 200,000. Okay, and what's the payment amount? 843.21. Okay, what's the current balance? 187,088.32. 187,088.32. Okay, and then our current income, if we take a look here, is 6,500. Okay, 6,500. So I type in 6,500 here, and what's our expenses is everything except for the loan we're trying to pay off. So $2,000 here, and then wablam, 3.7 years, it is all paid off. 3.7 years. Okay, that's pretty awesome. So 36 plus divide by no, that's just 6.7 years. Why am I? All right. So let me get rid of this equals. And how much debt is that? That's 319K. 319K. Debt free. All right. See how easy that was? 3 car loans, no problem. No problem. Folks, don't make this harder than it really has to be, right? And again, I know that people sometimes find my channel and I get these comments like, well, this isn't realistic and blah, 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 blah. I don't care. I don't listen, no one's going to do this, right? No one's going to get a $280,000 line of credit and, or pay off their mortgage off in less than 3 years or buy a property under $100,000 market value, don't worry. I don't know what I'm talking about. But if we're judging ourselves based on what the average is, this is definitely not not likely, right? But if we base it on having good foundations and financial principles, the likelihood of doing the things that I'm talking about is much higher. And if you want to have a good foundation, click the Google form link below. All right, well that's it, folks. Paid off 3 cars in really about how many months? 9 months. 3 cars, 9 months, pretty good, right? All right, well that's it. Okay, I'm good. I'm good. I think I am. Have a great day, everybody. It's Karina Lanta Mentorship.